Welcome to Blind Spots, a podcast where we're helping you fill the gap between what you want to do with your money and what you actually do. We are professional investors, writers, and financial planners helping you navigate the complexities of finance to optimize what you can control and cut out the rest. Join your host, Nik Shermans and Aaron Varghese, as we discuss the questions and nuances surrounding everyday money management.
Welcome back, everyone, to Happy Half Hour with Toby and Nik. For those of you who don't know who we are, we're nobodies, but we are going to talk markets and ask each other some questions, give you some insight into the way we think about certain asset classes, what's going on in the market. There's no shortage of topics to discuss. So, Toby, what have you got?
First of all, speak for yourself. You might be a nobody. I don't consider myself a nobody. Yeah, I've got a few topics for us today. So I thought the first one, give you the opportunity to talk a little bit about our recent addition to the firm and what he's going to hopefully bring to the firm and how excited we are to have Tim on board.
Yeah, so we've been looking for a lead advisor for over a year, and we've gotten in front of some really smart people, but we're very particular about our culture and the mindset that we want to introduce to our growing firm. So we came across Tim, and Tim is originally from Hong Kong, younger guy, very sharp, very astute, growth mindset, made his way to Reno, Nevada, and helped another financial company grow and was involved in all sorts of their back office, their operations, their client-facing approach, and started going down the path. We made Tim an offer. He accepted, and he started about a month ago, and he's getting fully immersed in the way we operate at Pure, sitting in on client meetings, getting to know our back office systems, our firm culture, and he's already showing his chops. I mean, I think when you come from a small company, you have your hand in multiple things and you develop range. And I'm really excited for what Tim brings to the table because he's, again, from Hong Kong, and I think as you grow, you want to bring in diverse backgrounds, diverse points of view, because you see things from different angles. So one of the things that is going to be a thing for us going forward is when someone comes in after the 3-month mark or 6-month mark is to look at everything that we're doing and give us feedback on what we can do better, different ideas, weaknesses. So Tim's going to be doing that, but I'm really excited. It's great to have some new blood in the building. It brings an energy and really adds to our culture.
Yeah, and Tim's getting up to speed on not only Pure, but obviously getting registered and all the requirements he needs to go through to be an advisor. But we've already, to your point, Nik, already seen ways that he looks at things a little bit differently and value that he brings to the table. So we're excited to have Tim on board and can't wait to get him fully up to speed and immersed and ready to pitch in and help. Great. Okay. I thought we'd talk today about an asset class. Maybe on these periodic podcasts, I'll bring up an asset class that's top of mind and I'm getting questions about, and just kind of get your thoughts, Nik, on how you're thinking about it currently and how it looks to us today. So the one today is a little bit of a off the mainstream, but kind of commercial real estate REITs. So obviously they've been beaten up quite a bit with the rise in interest rates over the last couple of years. So maybe talk a little bit about how you think about commercial real estate today and REITs today and why they're part of the portfolio going forward.
So there is pain in REITs. That's no secret. It's been a known risk for over a year now. And I always say this to people, when people are talking about a certain risk, if they're talking about it, it becomes less risky because it's expected. And true risk is what you don't think about. So I was asked this yesterday, and there's a few things to unpack here. One, probably the most important thing in my opinion is when you think about an investor's asset allocation and their exposure to REITs, the modern day REIT, as I call it, looks a lot different than it did in 1995, let's say, where it was heavy in malls, it was heavy in retail, it was heavy in brick and mortar office space. When you unpack the composition of the modern REIT today, like an index, it's heavy in data centers, storage units, multifamily housing, cell phone towers. It doesn't look like your grandfather's REIT. So I think overall exposure for most investors that own a passive REIT index is much less than you would expect. And that's the beauty of owning an index. It morphs into what's in favor. You own more of what's in favor. You own less of what's out of favor. Okay. And then the other thing that I'll say is a lot of these commercial office building investors, commercial real estate investors are the most sophisticated, smart investors on the planet. They're not just going to throw their hands up and say, hey, I made a crappy investment. I'm going to mark this down by 50%. I'm going to turn the keys into the bank. Sure, there might be some of that, but a lot of these folks are starting to repurpose their properties, turning them into multifamily housing, turning them into a distribution center for an Amazon or a FedEx, or this trend that has swung extremely from work in the office to work from home is slowly probably going to balance itself out over time. It's not an all or nothing thing. Like I'm only working from home from now on. Companies, big and small, and we're kind of going through this, are trying to find the right balance between working from home and working in an office.
And to be clear, I think in the portfolios that we put together for folks, commercial real estate or REITs tends to be kind of in the 2 to 6% range. Is that a fair statement? So it's not as if it's dominating a portfolio or it's 20-25% of the portfolio. It's a smaller piece, but it provides diversification and provides income in a lot of cases.
Yeah, and we've been underweight REITs for most of this year. We went recently, a few months back, max underweight REITs. So that's the beauty of our investment process is we want to own an asset class, but if it's out of favor, we're going to own less of it. But that said, looking forward at the opportunity set of investments, REITs are down in some cases 35 to 40% over the last 18 months. It's a tangible asset. You can touch it. And as you said, it's an inflation hedge. It provides income. There's some smart investors out there that are starting to sniff around in the public REIT space.
Okay, great. Next question I had is, as we look at 2023 and even to some extent 2022, you can make the argument that over this fairly short period, diversification has actually been a hindrance, not a help to portfolios. Now, we obviously believe strongly in diversification, and history has shown that diversification is critical to building portfolios that compound and grow over time. But how do you advise folks, or how do you talk to folks about, hey, when there's a stretch of time where diversification doesn't seem to be helping and they're wondering, hey, why don't we have more of those areas that are working? And why do we have so many of these other areas that maybe aren't?
There's a lot to unpack there. The first thing I would say is diversification not working is the exception to the rule rather than the rule. And if you think back from March 22 when the Fed started hiking and we got this unexpected inflation, that was essentially a regime change from low inflation, low rates. And it turns out, as we zoom out and look at the last 18 months, unexpected inflation and higher rates, the most aggressive Fed we've seen in 40 years, that's bad for all asset classes. So there wasn't a lot of places to hide last year. I think over the last 2 years, the best performing asset classes were cash and gold. And that's it. Everything else is still down. So like beloved tech stocks that people want to ask, why don't you own more of these? Well, a lot of those are still upside down when you look at the last 2 years. And many of those were down 40, 50, 60% last year. So nothing is simple in this environment. And I often say people make mistakes when they look at past business cycles and compare it to this one, because we're still dealing with unintended consequences coming out of a pandemic. All right. So nothing is normal. There's pockets of strength in this economy. There's parts of this economy that are completely broken. So yeah, probably the most uncomfortable part about the last 18 months or so is diversification breaking down, because a lot of retirees, a lot of folks that are looking to manage risk experienced a drawdown in a safe asset class like bonds. And oftentimes the more conservative folks were down more than the more aggressive folks that were invested in tech stocks. That completely is backwards based on everything that we've known to be true about diversification and asset class correlations and risk. So again, this is just an uncomfortable period. What I've said all along is as the Fed pauses, as they signal the end of their hiking campaign, and it looks like they're in the bottom of the ninth, that should provide some stability. Okay, the market doesn't like when the Fed might hike one more time or might hike twice more, or inflation's giving us these false starts. But it looks like that's starting to work itself out, which should bode well for diversification starting to work again.
And as part of the diversification benefit is, obviously no one knows what's next. No one knows the future, but you can go back in the not too distant past and find periods where, international stocks far outperformed US stocks, small cap stocks, emerging market stocks far outperformed other types of stocks. And so in advance, you wouldn't have been able to predict that necessarily. So having a diversified portfolio ensures that you're going to benefit from those periods, because you're going to own some of the things that are moving higher, and you'll also own perhaps some of the things that aren't moving higher. But overall, the portfolio will move forward over time because of that diversification.
Well, and look no further than an asset class quilt. Like we've all seen those. They go year by year, different colored squares. The bottom squares are those that underperformed. And then as you go forward, the top squares are what's outperformed. And it's often the lowest squares from previous years tend to be the outperformers in the following years. And the best performers tend to be the worst performers in following years. So most investors do the opposite. They chase into what's worked or what's working now, and seldom are yesterday's winners tomorrow's winners. Sure, there are some exceptions. Tech, the last 12 years, is probably the biggest exception, but certainly looking at a quilt like that, it's really hard to predict what's going to sustain performance or what's going to continue to outperform.
Okay, that's good stuff. A new segment I wanted to bring out today is I'm going to give you the description of a type of investor, and I wanted to see if you could share your thoughts on what people in that situation should be thinking about. So we'll call it the advise me section. Obviously, we're not talking about anyone specifically. Obviously, this advice is meant at a high level, but talk to me about a kind of mid-career, someone in their mid-40s to early to mid-50s, has a family and is started to make more money in their job. Talk to me about what that investor, what that person should be focused on today at that point in their life cycle.
This sounds like compliance entrapment, but I'll go ahead and try to give it my best answer, because this is kind of me. I have a lot of friends, 40 to 50, that are starting to make more money. No, I'm not saying me, but I'm saying my peers are starting to make more money. And maybe I'll answer your question backwards and invert the problem, because these are some of the things that I see that I don't like. And these are going to be random. People making more money, but also spending more money. Kind of the keeping up with the Joneses. We call it lifestyle creep. And when those around you are making more money and maybe they're buying these fancy houses, it might incentivize you to do the same. But I would challenge those that have a keeping up with the Joneses tilt, even if you don't know you have that, to just pump the brakes and maybe that extra raise or that bonus, save it first, or max out your 401k first, max out your IRA first, and then look to maybe spend some other thing, spend the excess money. But don't go chasing fancy houses or expensive cars just because you're making more money. That's the quickest way to have less money. The second thing, go ahead.
No, go ahead. I was just I'll jump in there. We see a lot of folks that are 55 to 60 and wish they had saved more money in their 40s and 50s, because now they're under the gun to save, more than they really can comfortably do in order to get to where they want to be in retirement. So those are pretty important years to be saving, but I cut you off. Go ahead.
No, so the second thing is, again, these people are making more money. They are paying attention to what's happening in markets. They're getting hit with information. They're listening to podcasts. They're talking to their friends. They've got a 401k that they're kind of managing themselves. And they're starting to develop a hot take investment strategy, meaning trying to predict what happens next. And I've even met people that essentially swing trade or day trade their 401ks, jumping in and out of cash depending on elections or wars or the next Fed meeting. And it's just mind-boggling to see someone who's got 20 more years to work, save, invest, and compound to make these catastrophic errors. Because once the dollars get up to a certain point, your mistakes become much more real. And it's almost a curse to be right too. So I have one friend, he market timed his 401k and turned out to be right. And it turned out to be the worst thing ever to happen to him because he's done it again and again and again. And the more decisions you make, the more large active decisions that you make, the more likelihood that you're going to be wrong. So he's ended up with egg on his face and a bunch of remorse and beating himself up. And it's just not worth it. I'm not saying you can't have opinions or can't have a side trading account, but for your core wealth piece, just optimize your savings rate and leave it alone. Build a portfolio that reflects the way that you feel about risk. Save, invest, compound. Let that work for you. Express your active views with a smaller portion of your investable assets.
Yeah, and the other thing I would add to that is debt. We've seen people that will run up credit card debt or will continue to have credit card debt, and again, that can be a real drag on your wealth and the growth over time. So, credit cards, paying off credit cards as your income goes up, and really trying to minimize your debt. Maybe you have a mortgage, but trying to minimize the debt, especially in this environment where rates are no longer 2, 3, 4%. They're pushing 6, 7, 8% or higher. So trying to minimize that debt. And then to your point, just almost keep it simple, stupid type of an approach. Put money away, max out your 401k if you can do it, and let that money grow for you over time. If you have money left over after contributing to your 401k, then find a way to invest that and have that grow as well. But I agree with you. We see people whose income goes up, their spending goes up, which is very normal and natural, but you want to make sure that your savings is also going up along with your income. Okay. Do you have a question for me? Because I've got a couple more for you, and we want to make sure we keep it to a happy half hour.
I do have a scenario/question for you. So I was doing my weekend reading and I stumbled across a chart, and maybe we can link this chart or link the blog in the notes. What is your reaction to this? Okay. So as of last Friday's close, the Russell 2000 index, the entire Russell 2000 index's market cap was surpassed by Apple and Microsoft. So Apple and Microsoft, not combined, but just alone, those two companies alone are bigger than the 2,000 smallest companies in the US. And when I say small, I'm talking market caps of 500 million to 5 billion. So not really small. But what's your reaction to that?
Yeah, I wish I could say that I was shocked and dismayed, but I'm not surprised because you've seen this year as rates have moved higher, and even last year, small cap stocks have underperformed and not done well. And they're really trading at almost a historical valuation low compared to, large cap stocks. And so I'm not surprised to hear that might be the case. The other factor is the Apples, the Microsofts, that's part of the Magnificent Seven that have done so well and have seen the PE ratio on those stocks, go from roughly 22 to 35 this year. So those stocks have gotten more expensive, and small caps have gotten less expensive. Now, you can make an argument that higher interest rates, higher cost of capital for debt is going to hit those smaller companies harder because they don't have as many levers to pull as an Apple or a Microsoft. But I think that the valuation has gotten to an extreme. Now, could it get more extreme? Absolutely. We've seen how that plays out over time. But I think, again, an argument for diversification and making sure you continue to invest in small cap stocks, because even if that normalizes, small caps are going to do well compared to their large cap brethren. What did you take from that chart?
Well, let's follow up with another hot data point that made my jaw drop. So small cap stocks in the US as a percent of the total US stock market, right? So Russell 2000 divided by total US stock market cap size, right? The average weighting for small cap as a percent of the total US market is right around 7.5% going back over the last 93 years. Guess what it is now?
4.
Pretty close. It's like 3.5 to 3. And these levels have not been seen since the 1940s, late 1930s. That's coming out of the Great Depression. So again, looking forward, investing is not just piling into the best performing asset class. if I'm an astute investor, I'm looking at the opportunity set. I can't ignore small cap. Small cap anything, value, growth, just the small cap index. If you played the movie forward in 10 years and you bought that today, it probably would be a pretty good trade. Now, I don't know if I can say that from a compliance standpoint, but I'm going to say it. That's a calculated risk that I would be willing to take.
Yeah, anytime you say I probably shouldn't say this from a compliance standpoint, it's probably something worth considering. So we'll take a look at that.
That's just my personal opinion. I'm not advocating you go out and buy small cap. I'm saying that's my personal opinion. If you bought small cap today, look back in 10 years, it probably worked out for you. I don't know.
Yeah, and you've made the point before that valuation isn't a great timing tool. You know, we've been adamant that international equities are much cheaper than U.S. equities, but they have been for 6 or 7 years. And so, you know, those valuation differences tend to resolve themselves over time. You just don't know how much time it's going to take to happen. So, you know, we'll add that caveat for the small cap discussion as well.
I've got another question for you. Guess what? 10 years ago for the S&P 500, what was the weighting of the top 10 companies in the index in 2013?
I would say the top 10 companies in the index in 2013 was 26%.
2013?
2013.
10%.
Okay.
Apple, Exxon, Google, Microsoft, Berkshire, GE, Johnson & Johnson, Walmart, Chevron, and Wells Fargo made up 10% of the S&P 500.
Isn't it 30% today? Sorry, am I jumping ahead?
Guess what it is today? Top 10 stocks.
Well, I thought it was over 30. Okay.
25%. And I'm not saying that's good or bad, but when you get a concentration of risk like that, like the S&P basically is the ultimate momentum index right now. So when you when you buy the S&P right now, you're buying mostly what's worked, right? It's very top heavy index, 25% top 10 companies. You're buying less of what has not worked. So some say it's the ultimate momentum investing strategy, which is fine if you know that, but a lot of people don't.
Do you ascribe to that theory that with all of the people putting money in on an automated basis through their 401ks, through other investing programs, that you really have a price insensitive buyer, meaning beginning of the month I buy, it doesn't matter what the price is, I'm buying. And that as a result, that drives the momentum and the top heaviness that you're talking about because it goes into those stocks on a market cap weighted basis. We're getting a little bit inside baseball here, but do you agree with that theory and that drives the market, or is this just another fluctuation that'll reverse itself likely over time?
I mean, I think that's a component that does make some sense, but like when you think about all the market participants out there and all the conflicting incentives and agendas and goals from pension funds to insurance companies and trillions of dollars of capital, I mean, everybody's pushing and pulling a different way. So I'm not sure, but I've done a lot of research on this, and having a concentration in any index doesn't necessarily spell doom for the index. What I can say is the top performers usually change over time and find it difficult to replicate some of their outstanding past performance. And I always say, look, if you want to buy Amazon or Google or Microsoft or Nvidia, no one's saying you can't earn a market rate return. Like if the index has a historical average of 7-8%, no one's saying that you can't get that in those companies. What I'm saying is if you're expecting 40-50% for a $3 trillion market cap company like Apple, you're probably going to end up disappointed. So it's a matter of managing expectations. You can own those companies. Don't expect them to replicate what they've done over the last decade.
Nope, I think that's fair. The next question I had for you, and this is a softball for you. I know you appreciate that. We have Thanksgiving next week. What is something that you're thankful for at this moment, and could be related to the firm, could be family related, could be anything you want to touch on? What's something that you're thankful as we head into Thanksgiving week next week?
I could go with the stock answer and say my family, but everyone assumes I'm thankful for them. I'm trying to come up with something a little more cheeky, but I'm really thankful. I got to be careful what I say here. Well, I'm thankful for those that I care about's health, right? So most people Don't know a lot of personal details about either of us, like a lot of our clients don't. But I lost my brother-in-law, my wife's sister, last year, and he was 43 years old. Died of brain cancer. Was a very active, healthy guy, and it was just a reminder how fragile life is. Like, tomorrow's not promised. So back in a previous podcast, I said I'm really focused on living in the moment and being where my feet are, as you put it. And I think that's really what I'm thankful for, is the health of my kids, my wife, those around me, because tomorrow isn't promised. I think sometimes we live with, oh, just wait till I do this in the future, then I can do that, or just wait until I get this new job, or just wait till I get a raise, or just wait, in 5 years I'm going to retire and then do this. It's like, let's maximize what we have in front of us today. Let's focus on the moment today. So that might be cheesy or weird, but that's really what I'm thankful for.
No, I think that's good. I'll take a crack at it too. And obviously, as you said, family is probably the most important thing to both of us. I've got 5 kids, and getting to spend time with them over the holiday and throughout the year is the best thing I get to do. But I'm also thankful for Pure Portfolios and the clients that we have. It's been a roller coaster couple of years with the pandemic, and then down year last year, and a bit of a quirky bounce back this year. But I love coming to work every day. I love getting to help people with their financial situation, with their financial plan. And so I'm thankful for having that opportunity, day in and day out.
That's good. Well, we're coming up on 30 minutes. So I hope you enjoyed this. If you have any feedback or suggestions on how we can make this better, or topics for us to talk about, shoot us a note at insight.com. We'll see you next time.
Thanks very much.